Oh, I have to turn off the mic. Could they not hear me at the beginning? I usually have a very loud voice, and this is something that I've been accused of frequently, yes. So global outlook, I'll go over the interest rate outlook, focused on the regional markets, as well as some conclusions, yes. Global outlook. The U.S. economy is doing pretty well. It's growing. It's not really robust. In fact, robustness is not common much of anywhere in the global economy at this point. Europe continues to grow. We're doing okay in Europe, including this region, aside from Russia and Ukraine. Commodity exporting economies are weak at this point, but the good news is commodity prices have stabilized, so things are getting a little better. And some countries like India and Poland are doing well without the high price of imports. China, the risk we worry about, China is a hard landing. That's something that's quite important for the global economy, since it's second or first, depending on how you measure it. Emerging market turmoil as the Fed gradually starts to raise rates, very gradually. Europe could go into recession with all the different issues happening. We've noticed, in fact, without a recession in the UK, a slowdown simply from the uncertainty over the vote on exiting or staying in the EU. In the US, we've started to worry about inflation risk. The Fed is going very slowly on raising interest rates, despite a low unemployment rate and rising inflation. So on the Fed policy, we have 2 more hikes this year. There was 1 last year. Up is better for our industry than nothing, but it's not very rapid increases. We also have the Bank of England following suit after the vote for being in or out of the EU. But the Bank of Japan and the European Central Bank, more quantitative easing, much more attempts to get rid of deflation as opposed to something of a tightening order. And this makes a very diverging set of monetary policies with the 2 big banks. Yields in the US and UK should go up a little bit. They're very low at this point, but with some tightening, some rise in interest rates, it's going to be a long time before in the major economies we get high interest rates that we can get good yielding investment returns on. So it's going to be a tough next few years on that front. Most emerging markets are doing okay, so we don't see any real problems there, and some are even raising interest rates to defend their currencies. Real, what we call real, after inflation, primary non-life insurance premiums are rising. It's kind of odd. We hear all about the price cuts, but what happens is we have terms and conditions become a price cut. So those are weaker terms and conditions. We also get growing economic activity, more cars, more houses. This adds to growth in premiums. And in addition, we have special deals so that if you have a smaller amount of coverage, you get more coverage for the same amount of premium volume. So we're having investment returns low for a while. Inflation low or falling in most economies. We only worry about the US on the inflation front. This shows you the track record of the major economies. I'll do some regional economies later. And you see the United States way ahead, 10% above where it was before the global financial crisis. UK and Germany about 5% ahead. Europe just barely on the Euro area. Just barely got above where it was 8 years ago, this previous quarter. Japan is about at the same spot. Spain coming up rapidly. Italy is the same size as it was in the year 2000, so it's been a very long struggle. And also, please note over here, the gross, on average, on per capita income since the year 2000, Japan is actually doing better than the Euro area. So when we talk about this Japanese situation in Europe, it's already here, and it's been here for 15 years. So it's not a question of growth on that front. It's really on a question of, do we have deflation in Europe? And that's why the European Central Bank is working so hard to avoid that part of the negative part of Japan. because of debt situations that come up with that. But with respect to per capita growth, already there, U.S. a little bit better, and of course U.S. has population growth, so stronger GDP growth. You see here the Purchasing Managers Index, not a lot of growth. Above 50 is growing, so you see post-crisis, you see a dip in Europe in particular, a bit better. Now we're just sort of slumping along. What I'd like to point out here is that China is misrepresented here. Above 50 is supposed to be expanding, below is shrinking. You see it's barely at, that would imply zero growth. But of course, when you look at the actual industrial production, it's not comparable to the other ones. It's at 6% growth in industrial production, quite strong. We'd be ecstatic over here in Europe to have 6% industrial production growth. And they have 11% growth in retail sales after inflation. So this is a strong economy, doing pretty well. A lot of hysteria about China, but economically it's doing okay. It does have a lot of debt issues and governance kind of issues. Germany, so closer to home, rising pace of employment growth, up to a little bit above 1%, 1.2. U.S. slowing a little bit, but still 2%, close to 2% growth. So these economies are doing okay. It's not really, really strong in Europe, not really, really strong in the U.S., but doing well. Seems to be sustainable, moderate growth, muddling along, we call it. I don't know if the phrase is familiar to you. You're sort of going along, but you're not doing terribly well. 4 risks we worry about in the global economy. First, the Fed is likely to tighten, or at least threaten to tighten, and as it does so, you get uncertainty in the markets, and this has been harmful to emerging markets in particular, collapse in currencies, inflation, maybe they raise their interest rates. So things have slowed down globally because of these kinds of headwinds, we call them, for the global economy. Second is China. China is changing. It's slowing down in growth. It's trying to become a more open economy. And as it does so, it affects the global economy in a greater extent. And in addition, you get announcements from these people that have never had to worry about the rest of the world. And so things have been unsettling to the global financial markets while this is happening. So you had the early part, you had the upset over a 2% movement in the renminbi last summer. And 2% is, of course, nothing compared to 30% or more we're getting in many currency movements. But very upsetting to the markets because it happened unexpectedly. The other one is commodity prices are low. So this hurts large parts of Africa, Latin America in particular. So Latin America is struggling with that. And energy exporters like Russia, Venezuela, Nigeria really hurting. But things have stabilized, so that's the good news. It looks like the bottom has hit on most commodity prices and things are going up, so that's good news for 2016. In addition, we have a few political developments globally. We have problems in Brazil, Dilma Rousseff up for being unstated. Russia has political problems as well as low oil prices, weak currency. China has debt problems. South Africa has Zuma with some corruption issues. So lots of issues there. Korea, conflicts all over the world. EU's somewhat paralyzed by immigration issues. Brexit, coalition in Brazil, etc., immigration. And of course in the US we have an exciting presidential election with the most eccentric characters we've ever seen. Three characters that are just sort of like astoundingly different and very unpopular too, which is kind of interesting. So the most unpopular people running for president in the US. So it's not just everywhere else in the world, it's us too, yes. Creating a bit of uncertainty. Sorry, if you hadn't realized, I'm American. My name is very German. I work in Switzerland. Ich spreche nur ein bisschen Deutsch and nicht sehr gut, aber this is what you get. Yeah. So we had a real scare earlier in the year, and credit spreads blew out, lots of issues with respect to concerns about the global market, but things have settled down and the credit spreads have come in, the equity markets have recovered, so things look like they'll be okay this year, nothing exciting. And you're seeing the same thing in emerging markets. Here in this region, emerging Europe, credit spreads have improved recently. It's Latin America with the commodities that the global economy, the global financial markets are most worried about. In Asia, you see not a lot of worries. It hasn't really even moved, so it's not a commodity exporter, and it's growing pretty well despite the issues of slowdown in China. Now I'll do the interest rate outlook, primarily focusing on the Fed, because the Fed is the arbiter of the global currency, the US dollar. And the way I look at it is unemployment's come down dramatically. This is the unemployment rate. Unemployment rate gets down, your labor markets get tight, wages go up, and you see a little bit of wage gains here. So things are getting a little bit more inflationary in the US. You see it here also. You see the inflation ticking up. And what's the Fed's reaction? Absolutely nothing. We're just sort of sitting on the 0.5 Fed funds rate. It's like 0.25 to 0.5 range. So that's kind of interesting. It's very unusual. So the statements include things like global economic and financial developments continue to pose risks. Never before has the Fed talked about anything outside of the United States with respect to making an impact of this magnitude on decisions. So it's some kind of funny way of not saying, I'd love to have some inflation. This would be inappropriate for the Fed chair to say, I'd love to have inflation, but she seems to want some inflation, and she's working very hard to get some to avoid any kind of risk of deflation, which would be very problematic at this point for the global economy, because that would be Japan, risks of it in Europe, and the US having deflation would be catastrophic, perhaps, for the global economy. So what's going to happen? Either we'll be fine, you know, it's possible that nothing will happen on the inflation front. I don't think so. I think we'll get some inflation, and the Fed will have to step in and raise rates. Or it could be the Fed, you know, so fine and not much action, a little inflation, and the action is appropriate and controls inflation, or the Fed is so far behind we get lots of inflation. So those are the three options we face in the US now, and the risk of the latter is quite high. I think there is some possibility that we won't get anything happening, but it seems unlikely given history in the United States with respect to inflation. ECB is just sitting there, but it's also trying to pump out a lot of assets and buy assets, now corporate bonds, keeping the spreads down. It's trying to get lending going. So what's likely to happen? It's likely that we'll avoid deflation and muddle along, but it looks like modest inflation at best. And it is working. We're seeing a little bit of an uptick in lending. I'm sorry, I got the wrong one. A little bit of an uptick. This is looser monetary policy in red for the euro area. In blue, a little tightening, but that's mostly from the fracking. The oil sector is under a lot of stress, and the banks are pulling back from them. What do you get with this kind of policy? The Fed tightening a little bit, and the European Central Bank pumping money out and buying assets. You get a big spread between the two 10-year yields, hugest spread. They used to think 100 basis points was a big spread between Germany and the US, and it's now 170 basis points. You also get a very weak euro. So this shows you what would be expected if you could go to the US and buy everything at the same price with euros and back and forth. And down here is where the euro is. It's one standard deviation from the expected level for buying the same amount of goods for the same price through the exchange rate. So it's quite far out, but it isn't as far out as it was when the euro was brand new. So it could go further out. So we're watching that carefully depending on what the Fed does. Fed raises rates, this could get, the euro could get weaker. Good news for exports. from this part of the world because you're often tied to the euro here in your countries, or literally locked into it or in the euro area. So I'll do a little bit more back home, closer to home now, your region. And I'll just put these all up there because I'm not very good with it otherwise. This is commercial down at the bottom. You see in sort of greenish, so my color translation never works with Microsoft. It was supposed to be kind of orangish, and it's now looks kind of greenish. But those greenish, light greenish ones are 0 to minus 10% price cuts in various lines from our friends at Marsh, as well as Council of Insurance Agents and Brokers for the US one. So mostly negative. The red ones are really negative. The bright green ones, the darker green ones, are positive, and a lot of stable also. So very slightly down globally on all prices for the various commercial lines in the various countries. If you look at, so we have to aggregate our premium volumes to get some numbers. We put them in US dollars, and when you do that, of course, dollar strong, everybody else weak, everything becomes negative in US dollar terms. There's a very big issue for large global companies because all of a sudden your profits from overseas and your premium growth from overseas is no longer positive, it's all negative because everything goes down in your accounting terms. Even in euro terms, mostly down if you have a big global emerging market system. So life premiums, however, if you get rid of the currency issue, it's been going up because growth has been going up. More cars, more houses still in most parts of the world. Profitability is under pressure with the pricing. And we're really surviving on low catastrophes and reserve releases from the rest of the world. Commercial segments under pressure, but there's new products, and that's helping premium volume growth. So this is your area of the world, and I do have Romania on there, just barely above where it was before the financial crisis, as you can see, for the local people. Here's Poland doing extremely well, came through the crisis very robustly. Now, if you recall, 10% was where the US was, so that's comparable to Slovakia here. So Poland is just off the charts if we went back to the previous slide. And here you also see the real struggler is Slovenia, and the rest are basically in the pack. You can see Russia going up and up and up and up, and of course crashing here towards the end with the big recession it has. Russia, just to focus in, negative growth last year, negative growth this year, but slightly positive in GDP terms, but weak going forward compared to previous history. And you see the currency following just along with the price of oil. It's just so transparent what's going on with the currency if you track the price of oil. And they're struggling now with deficits and paying for foreign goods with that, and they're struggling with not being able to collect enough revenue. One of the things we like to show about insurance is this S-curve. So very slow growth in premium volume when you're very poor a country, but accelerates rapidly as you hit the middle income and people start buying cars and houses and insure those goods. It starts off primarily as a non-life or motor and home insurance, and then it goes into life insurance, which goes very rapidly as people want to save with the savings products. But you see, with the weak economic activity, things have actually been going down. This is penetration, insurance premium divided by nominal GDP, and this is GDP, this is per capita income, and you see it accelerate as it goes there, and you see the many countries here going down over the last few years with respect to the crisis. Weaker economic activity, weaker premium growth is the key thing. But you've also had very competitive pricing, some scandals, some self-insurance up as people prefer to not insure and spend money on other things. Summary, economy, growth to improve, particularly in EU members, but economic activity in Euro area is doing well. Exports to that region will do well. So that's the big driver of growth here in the near term. But Russia and Ukraine, if you're a big exporter to these markets, you're going to have trouble for at least this year and only get a little bit better next year. The worst we worry about here is Ukraine deteriorating and making more of an issue with sanctions and conflict and weaker growth. But it could be resolved also, so things could get better. There's an upside and downside risk there. And the bigger thing is a contagion from emerging markets. What if something goes wrong in Asia and they think, wow, if Asia can be hit, why couldn't Eastern Europe be hit also with some kind of debt and financing issue? In the insurance markets, we're looking for it was down last year, and it'll be weak this year for the aggregate area because of Ukraine and Russia, but should be getting better, a little bit of growth this year and better next year. But we will have a dampening from external thing. I'll do Turkey briefly. I understand you have some interest in Turkey. Maybe there's some Turkish people here, also insurance companies. But growth has been doing okay there, but it has a lot of risk. It has high inflation, big debt issues, big current account balance issues, sanctions from Russia hurting growth, political issues. You see the premium volumes, this is US dollar terms, and you see this quite dramatically. Depreciation of the currency, of course, the premium volume may be up in local currency, but it goes down in US dollars, but then recovers with a stable currency. And you see the growth is not too bad in the 5% range with respect to non-life, and about the same in life. Getting to some more exotic areas, we did a Sigma recently, one of our premium publication on frontier markets, and we see Azerbaijan, Kazakhstan, and Georgia here, which were in that Sigma in this region. Low penetration, these are quite well off countries. When you look at the per capita income, there's some distribution issues, income distribution issues, but the penetration in the non-life side is very low compared to other countries of this level of per capita income. And so there's plenty of potential for getting some great growth there. What's happening there? We have, as you know, compulsory insurance comes in, you get some spurt in that. It's usually in the motor third-party liability, so some growth potential there. You've got, you need to have a regulatory framework, of course, that's very supportive for growth, and changes in policy can disrupt that if the regulatory environment is inappropriate. Some of the countries have Islamic populations like Kazakhstan, and takaful insurance is very helpful there. And getting more integrated in the global economy allows for best practices to come in as well as foreign insurers. So, conclusions? Growth is going to be okay, not really robust, but not bad. You know, we don't have a low probability of a big recession this year. We're watching it carefully because of the credit conditions. Long-term interest rates up a little bit, but not a lot. We're going to wait a long time to get some higher investment yields. Regionally, growth is improving, but there's a damper because of exports to Russia and Ukraine, improving exports into the Western European area. A slow rise in interest rates is a tough haul for us. Premium growth is still going up, but it's modest, and pricing pressure is quite severe. So at best, we'll get stable prices. That would be good news. That's the optimistic outlook of stable prices in the global insurance markets. We're surviving on low cat and reserve releases. So if that reverses, we'll get some pricing increases. But hard to forecast, even my forecasting ability, maybe it extends to this inflation and what the Fed is doing, but it doesn't extend to natural catastrophes. These are very hard to forecast, so I can't do that. And reserve releases are extremely hard to forecast. We think it's getting a little bit more severe. We hear about more from our clients that's dampening, and some companies are having some problems. So this will probably reverse over the next couple of years, adverse developments and price improvements. So thank you. I appreciate your time. I hope you enjoyed that.